What's up, crypto fiends? Average crypto investor, aka only capital losses, here to talk about what's going on in the market and ways that you can prevent major losses moving forwards. As always, nothing said in this video is financial advice, and you should always do your own research before investing into any project. In case you haven't logged into Twitter, looked at recent uploads on YouTube, checked CoinGecko or CoinMarketCap, or even checked your own balances, crypto has been on a downward trend over the recent weeks. As of recording this over the past few days, there have been huge drops across the top blue chip coins with massive liquidations. This has led to calls for a bear market, or even some saying we are in the midst of a recession. But I believe there's more to this than just the percentages that everyone is seeing. First off, let's talk about some macroeconomics at play here. Throughout the course of the pandemic, governments across the world have been printing money to try and provide relief. This has led to increasing inflation to levels we haven't seen in decades. In addition, the tech stock sector saw a more dramatic price recovery during 2021, and it seems they are now suffering larger losses as well. We have the Omicron COVID spreading like wildfire, resulting in more people missing work and losing wages. We also have unemployment rates back to pre-COVID levels, but low-wage jobs are still looking for people, and employees are holding out for higher-paying jobs. Mortgage rates have started to rise, and we aren't seeing the same buying pressure that we did last year. All of this is leading to a significant amount of economic uncertainty. Economic uncertainty leads to businesses de-risking and de-leveraging, which creates selling pressure. Large retail investors tend to rebalance portfolios during enhanced selling pressure as well, which creates even larger selling pressure in riskier assets. This brings us to the crypto market. Let's first take a look at the Bitcoin chart over the past 30 days. As you can see, Bitcoin has been on the decline before the new year, but we have had 3 dramatic drops over the past 30 days. The first was here on the night of December 27th, the next was here on January 5th, and then starting again on the 20th, ongoing as this is being recorded. It might be easier to view these dramatic price swings as candles so you can see just how large and sudden the drops were. So we have our Bitcoin chart, and we also have our stock market looking like this over the past week. The overall crypto market is looking like the Bitcoin chart as well. So what's causing all of this? Is it simply that people are being fearful of moving into stablecoins or cash in the short term? We have 2 more things we need to take a look at first. Here we have crypto liquidations over the past hour, 4 hours, 12 hours, and 24 hours. That's right, we had $1.1 billion worth of liquidations over the past day. What exactly is a liquidation and how does it happen? I'm going to need you to head down and like this video and make sure that you're subscribed beforehand. Got that bell notification clicked? Alright, let's get into the crypto liquidations and how they actually happen. A liquidation is a type of investment transaction that happens when utilizing leverage or loans against your investment. Let's say you have 1,000 shares of Apple worth $150 each. This gives you a total exposure of $150,000. Let's say you get a line of credit against your investments for $100,000. That would give you a liquidation price of $100 per share of Apple, because your exposure then would be greater than the worth of your shares. Usually most investment companies use margin calls above your liquidation price to give investors time to add collateral to their position and avoid the liquidation process. When you go and take a loan against your crypto, you're given a liquidation price up front based off of the type and amount of tokens you are receiving in return for your collateral and how much your collateral is worth at the time. So let's go and say you had taken a loan against your Bitcoin when it is worth $50,000 and have a liquidation price of $40,000. You're feeling strong at the time because Bitcoin had already dropped from its all-time high recently, so you don't think it's going to break $40,000. Well, guess what, my friend? It did this past week. So your Bitcoin loan just got liquidated. So that means the lending protocol now owns your collateral, aka your Bitcoin. However, the protocol needs to either reclaim their stablecoin or fiat that they had before. If it was a loan in which another individual had lent out their assets for you to borrow, the protocol needs to make sure that that person is made whole. All of these situations require selling Bitcoin in exchange for whatever asset is needed. Unfortunately, this increases selling pressure as these liquidations happen, which creates a compounding effect, causing more people to get liquidated as new lows are reached. Now everyone across the market is panicking because they need to cover their loans and avoid liquidation. They think, well, I got some Phantom over here and some Ethereum over here, so I'll sell those and buy some Bitcoin so I can add that to my position so I won't get liquidated. This is how those cascading liquidations tend to have compounding effects, because now those other coins are getting sell pressure, and then loans against those coins start to be liquidated. This is what we can see by our liquidation charts and how hard it's hitting every single market. So you're probably sitting there thinking to yourself, alright, all of this sucks and will compound on itself, but what am I supposed to do about it? How can I help myself? Well, there are a few things. First off, avoid leverage unless you are absolutely sure you know what you're doing and all of the risks that are associated with it. The second thing you can do is utilize dollar cost averaging when entering into new projects and tokens. And then while holding those tokens, you can find ways to earn more tokens while holding it. Things like yield farming and staking can be incredibly beneficial over the long run when you're holding a particular asset. If you'd like to learn more about my personal yield farming and staking strategies, let me know in the comments down below. The last thing that I would recommend is always having some liquid assets, whether that's fiat or stablecoins, just so you can buy dips at price points when these events happen. Remember, always do your own research and never invest more than you're willing to lose. In conclusion, the whole world is scared and anxious about what's coming next. When people are scared, they tend to keep their wallets closed. Closed wallets mean taking profits and looking to move your money into less risky investments. This creates an initial storm of sell pressure across all markets. Crypto has a subsection of investors who are utilizing leverage of their portfolios to amplify their gains. Unfortunately, some of them start to get liquidated by the initial sales pressure. These liquidations create a cascading liquidation event several times over the past month, with the most recent one resulting in over $1 billion of liquidations. The cascading liquidations create more fear in the market, which starts the cycle all over again, creating even more sales pressure. Do you like these Stay of the Market videos and my insight into what's going on? Let me know in the comments below, or if you'd like me to cover something more specific. As always, go ahead and like the video down below and subscribe with the bell notification turned on so you can be alerted when my next video goes live. That's all for now. Stay safe and don't worry, crypto fiends. We are all going to make it.